Welcome back to our deep dive. We're digging into the source materials you've provided to pull out the essential insights.
That's right.
Today, we've got a really significant document, Part 4A.pdf. The official title is International Independence Standards, Parts 4A and 4B.
A key one, definitely.
And you flagged this one because Part 4A is all about independence for audit and review engagements. So our mission today is pretty clear. Cut through the complexity and really understand the core ideas, the rules that make sure financial reporting is trustworthy.
Exactly. It's about maintaining that credibility. We'll look at the scenarios in the document, try to get a real practical feel for what independence means on the ground.
Think of it as getting to the heart of the rules that keep financial statements reliable. It's more than just ticking boxes, you know?
Absolutely. It's about the principles that uphold confidence in the whole financial system.
Okay, let's jump in. Section 400, applying the conceptual framework to independence for audit and review engagements. The basic idea seems simple enough. Accountants doing audits or reviews have to be independent.
That's the bedrock, yes. The absolute starting point. And it's crucial to get that this independence isn't just one thing. It has two sides.
Two sides, okay.
First, you've got independence of mind. This is basically your internal state. It means your ability to make conclusions isn't swayed by influences that might compromise your professional judgment.
So acting with integrity, objectivity, being skeptical, thinking clearly without bias.
Precisely. It's that internal compass. Then the second part is independence in appearance.
Ah, how things look from the outside.
Exactly. It's about avoiding facts and circumstances that are so significant that a reasonable, informed person looking in would likely conclude, hang on, this firm's or this auditor's integrity, objectivity, or skepticism might be compromised.
So even if you are unbiased in your head, if it looks like there's a conflict.
That erodes credibility just as much. The document is really clear.
Yeah.
Being independent means following all the rules laid out in this part.
Okay, so for an audit, it's twofold. Follow the audit rules, yes, but also rigorously apply this independence framework. You mentioned Section 120 gives the framework.
That's right. Section 120 lays out the conceptual framework. And Section 405 has specifics for group audits, which can get complicated.
And this Part 4A, it doesn't just list rules, does it? It talks about threats.
Yeah, that's really helpful. It describes situations, activities, interests, relationships that could create threats to independence. Then it talks about potential actions, including safeguards, to deal with those threats.
Safeguards, like countermeasures.
Sort of, yes. Ways to reduce the threat to an acceptable level. But importantly, it also flags situations where the threats are just too big, where no safeguard is enough.
Red lines, got it. Now, the terms engagement team and audit team come up. What's the difference? Who's included?
Good question. The audit team is the wider group. It includes everyone doing audit work on that specific engagement. Yeah, the direct team members, partners, staff in the firm working on it. But also individuals doing audit procedures who might be from a network firm, or even a firm that's not in the network, or another service provider.
Like someone from a subsidiary's auditor doing work for the main group audit?
Exactly that kind of thing. They're part of the audit team. Think of it as anyone who directly contributes audit evidence.
Okay, so it's about the work being done. And a service provider, that sounds different.
It is. A service provider is an external person or organization providing a resource used in the audit, maybe specialized software or expertise, but they aren't part of the firm, the client's network, or anything like that. They're truly external specialists.
Makes sense. The document also mentions experts within or engaged by the firm, network, or component auditor firms. Are they on the audit team?
Yes, if these experts directly influence the audit through consultations on technical issues, industry specifics, transactions, things like that, they become part of the audit team.
What about the engagement quality reviewer, that extra check?
Ah, right. If there's an engagement quality review, the reviewer and anyone helping them, they are considered part of the audit team. But, and this is a key distinction, they are not part of the engagement team.
Why difference?
It likely reflects their role. They're providing objective oversight, kind of separate from the team doing the day-to-day execution of the audit work.
Okay, stepping back for oversight. Got it. Now, public interest entity, PIE, that term keeps appearing. What makes an entity a PIE, and why are the rules stricter?
Right, PIEs. These are entities where the public has a really significant stake in their financial health. The document looks at two things. The nature of the business, like holding assets for lots of people, think banks, insurance companies, pension funds.
Okay, fiduciary capacity.
Yes.
Yeah.
And second, its size, often things like number of employees, The independence rules are tougher for PIEs because, well, if something goes wrong, the impact on the economy and public trust is much bigger.
Higher stakes. Makes sense. The document mentions audit reports might have restricted use, and Section 800 allows some modification of independence rules sometimes.
Yes. That's a very specific carve-out for particular circumstances detailed in Section 800. But for the vast majority of audits, the core principle holds. The firm must be independent and use the Section 120 framework constantly to spot, evaluate, and deal with any independence threats.
Now, a big one. The ban on taking on management responsibilities for an audit client. This seems like a really hard line. What is management responsibility here?
It's about controlling, leading, directing the entity, making decisions about resources, human, financial, tech, physical, intangible.
So like setting strategy, hiring and firing.
Exactly. Setting policies, strategic direction, hiring, firing, directing employees' work, authorizing transactions, controlling bank accounts, deciding on the firm's recommendations, reporting for management to governance.
Okay, definitely running the business.
And critically, taking responsibility for preparing the financial statements or designing and maintaining internal controls. Those are management jobs, not auditor jobs.
Very clear line. But auditors often give advice, right? Recommendations, where's the boundary?
Crucial distinction. Giving advice and recommendations to help management do their job is fine. It's not taking on their responsibility provided the client makes all the final judgments and decisions.
The client has to own the decision.
Absolutely. The auditor provides input, the client decides, and is accountable. Now, the document does warn that even giving advice could sometimes create a self-review threat. We'll get more into that with Section 600, but the key is client control.
So if a firm does any professional activity for an audit client, they need to be sure management is really in charge of their own responsibilities. How do they check that?
The firm needs to be satisfied. The client has designated someone's suitable right skills, knowledge, experience to oversee the activity. They need to check the client understands the objectives, the nature, the results, and who's responsible for what client versus firm.
Does the client need to be an expert in what the firm is doing?
No, not necessarily possess the technical expertise to do the activity themselves. But they must provide proper oversight, evaluate the outcomes, and ultimately accept responsibility for the actions taken.
Right, oversight and accountability. Okay, let's shift to related entities. How do they fit into independence?
Good point. Related entities here mean entities the audit client controls, directly or indirectly. The key thing is, when you're assessing independence from your audit client, you also have to consider these related entities when looking for and dealing with threats. The scope widens.
So look at the whole corporate group connected to the client. Makes sense. When exactly does this independence need to exist? Just during the audit itself?
No, it's broader. The period during which independence is required covers two things: the engagement period itself and the period covered by the financial statements being audited or reviewed.
And the engagement period starts when?
As soon as the audit team begins doing any audit work. For a recurring audit, it ends later of either party saying the relationship is over or the audit report being issued.
So it can stretch out. What if a company becomes an audit client after the period the statements cover, but before the opinion is issued?
Then the firm has to look back. Did they have any financial or business relationships with this new client during or after that period covered by the statements? Did they provide any services before becoming the auditor? They need to assess if those past connections create any independence threats now.
Okay, retroactive check. And what about non-assurance services consulting tax stuff done before they became an audit client?
Oh yes, that can definitely create issues. If a non-assurance service was provided during the period the financial statements cover, but before the audit team started the audit work, that could create threats.
Like a self-review threat, reviewing work your own firm did.
Potentially, yes. If those threats are significant, the firm must apply safeguards. Maybe ensuring the people who did the non-assurance work aren't on the audit team, or having an independent reviewer look at the audit work or the non-assurance work, or even getting another firm outside the network to evaluate the results of that earlier service.
And if the safeguards aren't enough?
Then that non-assurance service can't continue in a way that would stop that other firm from being able to take responsibility for it if needed. And even services provided way before the statement period or the engagement period can still pose a threat. It depends on the service, its significance, and how long ago it was. It still needs evaluation.
Right. Now, PIEs again. The rules are tougher here for prior non-assurance services.
They are. A firm cannot accept appointment as auditor for a PIE if the firm, or a network firm, provided a non-assurance service before the appointment that could create a self-review threat for the financials they'll be auditing.
Full stop.
Almost. The only way is if the service stops completely before the audit engagement period starts and the firm takes steps to address any threats, and they determine those threats are eliminated or down to an acceptable level. Steps might include subjecting a service result to audit procedures or getting another firm to review it. It really shows the extra caution for PIEs.
Makes sense. The document also flags communication with those charged with governance. That seems like a constant theme.
Absolutely. Keeping the board or audit committee informed is vital for trust and dealing with any independence concerns proactively.
Okay, let's talk about Section 410. Fees. Money. This feels like an area ripe for potential issues.
You're right. It absolutely is.
Yeah.
The basic idea is that fees for professional services can create self-interest threats to independence. So firms have to apply that conceptual framework. Again, identify, evaluate, address threats coming from the fees charged to audit clients.
What sort of things create these threats? Is it just the amount?
The level of fees is one factor, yes. Do they reasonably reflect the work needed? But it's broader than that. Is there a link between audit fees and fees for other services?
Like getting the audit cheap because you buy lots of consulting.
That's the kind of linkage to watch out for. Also, does the fee depend on the outcome of the service? Is the fee being paid to the audit firm or a network firm? How big is the fee relative to the service? How is the firm structured and compensated? How important is this client to the firm or to whoever referred them?
Wow, okay.
And what about the client's related entities getting other services? How involved is the client's governance in setting the fee? Is it set by an independent third party? Is the audit quality reviewed externally? All these things feed into the threat assessment. The firm's own quality management system matters too. It's a lot to weigh up.
Definitely sounds like it. What about the audit fee amount itself? Can it be too low or too high?
Yes, both can raise flags. If there's heavy pressure from the client to cut the fee way down, or if the fee seems unrealistically low for the job, that could create self-interest or intimidation threats. You might need safeguards, like having an independent reviewer check if the fee is reasonable for the scope, or review the actual audit work performed.
And how do fees for other services affect the audit fee? Can you bundle them?
Generally, no. Providing other services isn't usually a proper reason to adjust the audit fee, but there's an exception. A firm can consider cost savings they achieve from experience gained, providing other services to that client when setting the audit fee. That acknowledges efficiency.
Okay. Contingent fees. These sound dodgy from the start. What's the rule?
Very strict. A firm cannot charge, directly or indirectly, a contingent fee for an audit, period.
And a contingent fee is one based on the outcome, right?
Exactly. Calculated based on the outcome of a transaction or the result of the service. Even indirect ones, through an intermediary, are banned. And it goes further. A firm or network firm also can't charge a contingent fee for a non-assurance service to an audit client if the fee is material to the audit firm or a key network firm involved in the audit, or if the outcome of the non-assurance service, and thus the fee, depends on a judgment about something material in the financial statements being audited.
So no situation where the auditor's pay depends on the audit result or the client's numbers looking a certain way.
That's the core principle. And even if a contingent fee for non-assurance service isn't strictly banned by those rules, it might still create a big self-interest threat. You'd need to look at the range of possible fees, who determines the outcome, disclosure, the nature of the service. Safeguards might be needed, like separate reviewers or personnel.
What about the total amount of fees from one client? If a firm gets, say, 80% of its revenue from client X, mostly from consulting, is that an independence issue?
It certainly could be, yes. When a large chunk of a firm's total fees comes from one audit client, especially if a lot is non-audit work, including from network firms, it can create a perception issue. Is independence compromised?
And an intimidation threat, too. Scared of losing the big client.
Exactly. You'd look at the ratio of non-audit to audit fees, how long this imbalance has existed, what the non-audit services are recurring, required by law. Safeguards might involve an independent review of the audit work or scaling back the non-audit services.
Another fee issue. Overdue fees. What if the client just isn't paying?
If a significant amount of fees stays unpaid for a long time, that's a self-interest threat. The firm has to ask, is this basically a loan to the client? If so, Section 511 on loans kicks in. And they also had to ask, should we even continue as auditor or accept reappointment, maybe get partial payment as a safeguard, or have an independent reviewer check the work?
Fee dependency seems really sensitive, especially for PIEs.
Extremely. If total fees from a PIE make up a big slice of the firm's total fees, that reliance creates a major intimidation threat potential. The code sets a specific threshold here.
The 15% rule.
That's the one. If, for 5 consecutive years, total fees from a PIE client and related entities are more than 15% of the audit firm's total fees, the firm has to seriously evaluate the threat level. If it's not acceptable, then before issuing the opinion on the 5th year's financials, they must have a professional accountant, someone outside the firm, review that 5th year's audit work.
A mandatory external review.
Yes, and if that dependency continues past 5 years, the firm needs to question if they can even continue as auditor.
Wow. Any way around that 5-year limit?
Only a very narrow exception. They can continue if there's a compelling public interest reason, but that requires consulting with a regulator or processional body and getting their agreement that it's truly in the public interest.
And even then?
Even then, for the 6th year and onwards, they still need that external pre-issuance review by an independent accountant each year. A compelling reason might be, say, there are literally no other viable audit firms available.
That's a high bar.
It is. And there are similar, slightly less intense rules if the 15% threshold is breached for just 2 consecutive years, with a PIE that triggers a pre-issuance review requirement for the 2nd year. If that 2-year situation hits 5 years, the default is stepping down, again, barring that compelling reason exception. It shows how seriously PIE fee dependency is taken.
Absolutely clear. And transparency around PIE fees is also mandated.
Yes, specific rules require public disclosure of fee information for PIE audit clients, more transparency for stakeholders.
And communication with the PIE's governance about fees, what needs sharing.
For PIEs, the firm needs to tell those charged with governance about the audit scope, complexity, time spent, resource costs, the client's record-keeping quality, any fee adjustments from the original quote, and impacts from changes in laws or standards. They should do this promptly.
Is there an exception?
Yes, a limited one. If the PIE is a wholly owned subsidiary of another PIE, and it's consolidated, and the same firm or network firm audits the group statements.
What about fees for non-audit services for PIEs?
Those fees still feed into the overall fee dependency assessment and the potential threats, even if the service itself isn't banned.
And when that 15% PIE dependency threshold is hit, what specific communication and disclosure happens?
If fees exceed 15%, the firm tells governance, explains if it's likely to continue, outlines the safeguards applied, and discusses actions to reduce the dependency. Then the firm must publicly disclose the total fees charged to the PIE and the safeguards used, at least annually. If there are other threats from the fee dependency beyond the 15% aspect, those also need public disclosure, along with safeguards. Same subsidiary exception applies for governance communication.
Okay, and lastly for fees, a quick note on review clients. Less strict.
The core independence principle applies, but yes, some specific thresholds and requirements, especially the PIE-related ones like the 15% rule, might differ or be less stringent for review engagements compared to full audits. The details would be elsewhere, maybe Part 4B, but the need to apply the conceptual framework to fee threats remains.
Right, that makes sense. Okay, moving on from fees, Section 411 deals with compensation and evaluation policies. How auditors get paid internally affect independence?
This ties back to self-interest threats again. The main point is that a firm's policy shouldn't create incentives that might compromise audit quality.
So you can't pay auditors based on selling other services.
There's a specific prohibition. Key audit partners cannot be evaluated or compensated based on their success in selling non-assurance services to their audit clients. That's a clear conflict.
For key audit partners specifically, what about others on the team?
For other personnel, the firm needs to consider whether their compensation or evaluation creates a threat. For PIEs, the rules might be a bit broader, ensuring no audit team member is compensated for selling non-assurance services. The focus must remain on audit quality.
Okay, no rewards for cross-selling non-audit work, especially for senior people and PIE audits. Section 420, gifts and hospitality. Seems obvious, but what are the roles?
The threat here is self-interest or intimidation. Basically, a firm, network firm, or audit team member cannot accept gifts or hospitality from an audit client unless the value is trivial and inconsequential.
Trivial and inconsequential. That sounds subjective.
It is a bit. You have to use professional judgment. Factors to consider include the nature, value, intent behind the offer, timing, how often it happens. Accepting anything more than clearly insignificant could compromise independence, or look like it does. The same applies to offering gifts or hospitality to the client.
Keep it minor, keep it infrequent. Got it. Section 430, actual or threatened litigation. How does suing or being sued affect things?
This creates pretty clear self-interest and intimidation threats. If there's litigation, or even the threat of it, between the firm or a network firm and an audit client, independence can be compromised.
When does it become a problem?
It depends. You look at the materiality of the litigation and whether it relates to the audit itself. If it's significant, the firm might appear to be adversaries with the client, which isn't conducive to an objective audit.
What are the safeguards?
If the threat is too high, safeguards might include removing specific individuals from the audit team, having an additional appropriate reviewer who wasn't involved, or maybe even bringing in another firm not involved in the litigation to advise or review parts of the work. If it's litigation involving just one audit team member personally, the firm needs to evaluate that specific situation too.
Okay, litigation definitely creates tension. Section 510, financial interests. Owning shares in the client.
Big self-interest threat here. The rules are quite strict. A financial interest can be direct, like owning shares yourself, or indirect, like owning them through a mutual fund.
And who can't hold these interests?
Generally, the firm itself, any network firm, members of the audit team, and their immediate family cannot hold a direct financial interest or a material indirect financial interest in the audit client.
Immediate family, too. Spouse, dependents.
Yes. There are some very specific exceptions, like for certain types of trusts or employee benefit plans, but the general prohibition is strong. There are also procedures for dealing with inadvertent violations. And remember, this applies to interest in related entities of the client, too.
No shares in the client or its close relatives for the firm, the team, or their immediate family. Clear. Section 511, loans and guarantees. Similar idea.
Very similar self-interest threat. A firm, network firm, audit team member, or their immediate family generally cannot give a loan or guarantee to an audit client or receive one from an audit client.
Any exceptions? What about a mortgage from a client bank?
Yes, there are key exceptions. If the audit client is a bank or similar institution, loans or guarantees are permitted if they're made under normal lending procedures, terms, and conditions. Things like immaterial loans, credit card balances within normal limits, or car leases on normal commercial terms are usually okay. But significant loans outside of these normal banking relationships are prohibited. This also covers loans to the firm or network firm from a client.
So normal banking is fine, special deals are not. Okay, Section 520, business relationships. What counts here?
This covers close business ties that aren't part of the normal professional service relationship or normal arm's-length transactions. The threats are self-interest and intimidation.
What's prohibited?
A firm, network firm, audit team member, or their immediate family generally cannot have a close business relationship with an audit client or its management.
What makes it close?
It usually involves a commercial relationship or common financial interest. However, there's an exception if the financial interest is immaterial and the relationship is insignificant to both the firm individual and the client. Also, buying goods and services from an audit client is generally okay if it's in the normal course of business and at arm's length, like being a regular customer.
So no joint ventures or significant business partnerships, but being a regular customer is fine. Section 521, family and personal relationships. This must get tricky.
It certainly can. Threats here are self-interest, familiarity, and intimidation. The code distinguishes between immediate family, spouse or equivalent, and dependents and close family parents, non-dependent children, siblings.
And the rules differ.
Yes, the rules are strictest for immediate family. For example, an immediate family member of someone on the audit team cannot be a director or officer of the audit client or be in a position to exert significant influence over the financial statements.
What about close family?
For close family, it depends on the individual's role on the audit team and the family member's role at the client. If a close family member holds a key position at the client, like director, officer, or key finance role, it might create threats that need evaluating and safeguarding, potentially even requiring removing the individual from the audit team. Other close personal relationships, not just family, also need assessment.
So who your family is and what they do with the client really matters. Section 522, recent service with an audit client. What if an auditor used to work for the client?
Big potential for self-interest, familiarity, and self-review threats. An individual cannot be on the audit team if they served as a director, officer, or in certain key management roles for the audit client during the period covered by the financial statements they'd be auditing.
Reviewing a period when they were potentially involved in decisions.
Exactly. For PIEs, the restriction might be even longer. looking back further than just the period covered by the statements.
Okay. Section 523. Serving as a director or officer while being an auditor.
That's an absolute no-go. Creates massive self-review and self-interest threats. A partner or employee of your audit firm, or a network firm, cannot serve as a director or officer of an audit client. Full stop.
What about company secretary?
The role of company secretary needs careful consideration depending on the jurisdiction and the specific duties involved. If the role is seen as performing management functions, it would likely be prohibited.
Okay, auditors audit. They don't run the company. Section 524. Employment with an audit client. What if someone from the audit team leaves to join the client?
This raises familiarity, intimidation, and self-interest threats. There are specific rules, especially for PIEs. If a key audit partner leaves the firm and joins a PIE audit client in a key management position, there's usually a mandatory cooling-off period before they can take up that role. It depends on the role and jurisdiction, but typically at least a year. For other audit team members joining the client, or former firm personnel joining, the firm needs to evaluate the threats. Safeguards might include modifying the audit plan or having work reviewed by someone senior. The concern is that the former colleague might know the audit strategy or be able to influence the audit improperly.
Right, the poacher-turned-gamekeeper problem. Section 525. Temporary personnel assignments. Lending staff to the client.
Generally creates a self-review threat and is prohibited. You don't want firm staff acting effectively as client employees.
Any exceptions?
Very limited ones. It might be permissible for a very short period, maybe for emergency cover, but only if the staff don't take on any management responsibilities, the client directs their work, and the firm ensures the assistance doesn't compromise the audit. Significant safeguards would be needed.
Use with extreme caution. Okay, Section 540. Long association of personnel. The familiarity threat from auditors staying on too long.
Exactly. Familiarity and self-interest threats can arise if the same senior personnel stay on an audit engagement for many years. They might become too trusting of the client or reluctant to challenge them.
So partner rotation.
Yes, particularly for audits of PIEs. The code mandates rotation for key audit partners. This includes the main engagement partner, the engagement quality control reviewer, and other partners significantly involved.
What are the limits for PIEs?
Typically, an individual can't serve as the engagement partner or quality reviewer for more than 7 years cumulative on a PIE client. After hitting that limit, there's a mandatory cooling off period before they can return to that client in a key role.
How long is cooling off?
Usually 5 consecutive years for the former engagement partner, 3 years for the quality reviewer, and 2 years for other key audit partners who are involved for 7 years. For non-PIEs, rotation isn't strictly mandated in the same way, but the firm still needs to evaluate the familiarity threat and consider safeguards, which might include rotation.
Okay, mandatory rotation for key partners on PIEs to keep fresh eyes. Now, the big one. Section 600, provision of non-assurance services, NAS, to an audit client. This covers everything from bookkeeping to IT consulting, right?
Absolutely. This is a huge area and a major source of potential independence threats, mainly self-review, advocacy, and sometimes self-interest.
What's the overriding principle?
The absolute baseline is that a firm cannot provide a non-assurance service that involves assuming a management responsibility for the audit client. We covered what that means earlier.
Right, no decision-making for the client.
Beyond that, the permissibility of specific NAS often depends on whether the client is a PIE, the nature of the service, its materiality, and whether effective safeguards can be applied. Documentation and communication with governance are also crucial here.
Okay, let's quickly touch on the main types of NAS mentioned in the subsections. Section 601, accounting and bookkeeping. Can the auditor do the client's books?
For a non-PIE, it might be okay if the service is routine or mechanical and the client takes responsibility. But for a PIE audit client, providing accounting and bookkeeping services that form the basis of the financial statements is generally prohibited due to the high self-review threat.
So, no preparing the source records for PIEs. Section 602, administrative services.
These are usually okay if they're routine support activities, clearly administrative, and don't involve management responsibility, like helping with meeting minutes purely in an admin capacity.
Section 603, valuation services. Valuing assets or liabilities.
High self-review threat here. For non-PIEs, might be okay if the valuation isn't material to the financials or involves significant subjectivity judged by the auditor. But for PIEs, providing valuation services that are material to the financial statements or where the valuation involves significant subjectivity and will be audited, is generally prohibited.
Okay, be very careful valuing things you later audit, especially for PIEs. Section 604, tax services. This must be common.
It is, but it can create self-review and advocacy threats. Routine tax compliance, preparing returns based on client data, is often okay for non-PIEs. Tax planning and advisory needs more care is the firm advocating for a position whose validity depends on the accounting treatment. For PIEs, preparing tax calculations for the accounting records is generally prohibited if material. Certain tax advisory services that depend on uncertain future outcomes or aggressive interpretations might also be banned, as could acting as an advocate in resolving tax disputes if the amounts are material.
So, compliance okay-ish, aggressive planning or advocacy less so, especially for PIEs. Section 605, internal audit services.
Big self-review threat. For non-PIEs, might be possible to provide some assistance if the firm doesn't assume management responsibility for the internal audit function, and the client has ultimate responsibility. But for PIEs, providing internal audit services related to internal controls over financial reporting, financial accounting systems, or amounts disclosures material to the financials is prohibited. Effectively, you can't outsource significant parts of the PIE's internal audit function related to financial reporting to the external auditor.
Can't audit your own internal audit work. Section 606, IT systems services. Designing or implementing systems.
Another major self-review risk. For non-PIEs, may be okay if routine, not creating financial data used in statements, and client makes all decisions. But for PIEs, designing or implementing IT systems that form a significant part of the internal control over financial reporting or generate information significant to the financial statements is prohibited. The auditor can't build the system they then have to audit.
Makes sense. Section 607, litigation support services.
This can create self-review or advocacy threats. Providing services like acting as an expert witness or calculating estimated damages might be problematic if the amounts are material to the financials. For PIEs, the restrictions are tighter, especially around expert witness services where the outcome could materially affect the statements.
Section 608, legal services.
Again, advocacy and self-review threats. Acting in an advocacy role for the audit client in resolving a dispute or litigation is generally prohibited if the amounts are material. For PIEs, providing general counsel services or acting in an advocacy role is typically banned. Some routine legal advice might be okay if separate from the audit.
Section 609, recruiting services. Finding staff for the client.
Self-interest, familiarity, intimidation threats. Providing recruiting services for director-officer roles or senior management positions with influence over financial statements is generally prohibited for all audit clients. For PIEs, the restrictions might extend to other finance-related roles. Searching or reference checking might be okay for non-senior roles sometimes.
Don't hire the people whose work you audit. Section 610, corporate finance services. M&A advice, raising capital.
Advocacy and self-review threats. Promoting, dealing in, or underwriting the client's shares is prohibited. Advising on corporate finance activities where the outcome heavily depends on particular accounting treatments or affects material amounts in the financials can be problematic. For PIEs, many corporate finance advisory roles that involve promoting the client or specific transactions are prohibited.
Wow, okay. So the general theme for NAS is be incredibly careful, especially with PIEs, avoid management roles, watch out for self-review and advocacy, and when in doubt, stricter rules likely apply.
That's a very good summary. The potential for threats is high across many of these services. Applying the conceptual framework, understanding the specific prohibitions, especially for PIEs, and implementing safeguards where allowed is absolutely critical.
This has been incredibly detailed. So wrapping this up, the key takeaway really seems to be that independence, both truly in your mind and how things look on the outside, is the absolute cornerstone for audit and review integrity.
Couldn't agree more. This document provides that detailed roadmap, identifying threats, evaluating them, addressing them across all these different situations. It's all geared towards making sure stakeholders can actually trust the financial reports.
And it matters for everyone listening, right? Even if you're not an auditor, understanding these principles helps understand why we should be able to trust financial information, which affects, well, everything from investment decisions to job security.
Absolutely. Which leads to maybe a final thought for our listeners to chew on.
Yeah.
How do these very specific, sometimes complex, independence rules actually translate into the reliability of the information you use every day in your job or personal life?
Yeah, and maybe think about times when a perception of independence or maybe a lack of it really changed how much you trusted something you read or heard. It's fundamental, isn't it?
It really is. It underpins so much of the financial world's functioning.